Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So to start us off, I want you to imagine the global economy is, well, like a giant shopping mall.
Oh, that's a good way to look at it.
Right. And for like a decade, the massive anchor store, the one holding the entire Asian wing of this mall together, was Chinese real estate. I mean, those developers were the undisputed kings. They were borrowing billions, driving foot traffic, and really just setting the tone for the whole market.
Yeah, they were the center of gravity, absolutely.
Exactly. But today, the doors to that anchor store are locked. It's basically out of business. And overnight, it seems like a massive Japanese high-tech superstore has quietly moved in, taken over the lease, and just completely rewired the machinery of the Asian financial system.
It's honestly staggering when you look at the scale of this transition, because if you want to understand where the global economy is heading, you simply have to follow the money.
And the money is definitely moving.
Oh, massively. We're watching capital move away from, pouring concrete for apartments in mainland China. And it's flooding directly into building servers, funding artificial intelligence in Tokyo, and backing finance firms in India. It's a fundamental shift in who holds the debt and really who holds the risk.
Yeah, I was looking at the recent research on the offshore borrowing numbers for the second quarter of 2026, and the sheer volume is just, it's hard to wrap your head around.
The $154 billion figure.
Yes, exactly. The Asia-Pacific offshore bond market, which, for those listening, is basically just corporations stepping outside their home countries to borrow money internationally.
Right.
It hit a record high of about $154 billion in just one quarter.
Right, which is huge on its own.
But the crazy part is, out of that massive $154 billion pie, Japanese issuers took a staggering 40%. I mean, nearly half.
Which is just a complete inversion of the old world order. I mean, China used to absolutely dominate this space. But in that same period, Chinese issuance dropped to third place. They brought in only about $20 billion.
Wow. From being the king to just 20 billion.
Yeah, the international appetite for Chinese debt has pretty much evaporated. A recent analysis actually highlighted a really striking metric. Foreign investors currently hold less than 2% of China's onshore bonds. Less than 2%.
That is wild. International capital has practically vanished from their domestic scene, which, that completely changes the definition of an Asian investment for everyday people.
100%.
Like, if you have a mutual fund or a retirement account with an allocation to emerging markets, the underlying plumbing of that portfolio has just shifted right under your feet.
It really has. The risk profile has moved from a property developer in Guangzhou to a semiconductor firm in Tokyo.
But wait, that shift kind of forces a glaring question, right? Because for 30 years, Japan was famous for having effectively zero interest rates.
Right. Money was basically free.
Exactly. Money at home was free. So why on earth are Japanese companies suddenly stepping out into the expensive global market to borrow billions of dollars?
Well, the era of free money in Tokyo is definitively over. Domestically, their borrowing costs are actually shooting up.
Really? How high are we talking?
So on July 9th, 2026, Japan's 10-year government bond yield hit 2.9%.
Wow, okay.
Yeah, which is the highest it has been since 1996. And it hovered right around 2.73% through late July. When the foundational rate of a country spikes like that, it ripples through every corporate balance sheet.
So domestic borrowing is suddenly expensive, and that forces corporate treasurers to look outward.
Exactly. And they are looking outward because they're staring down a massive, massive bill. Prime Minister Sanata Kaiji introduced a monumental investment roadmap in July.
Right, I saw that. The scale of it is insane.
It is. The government is pushing for 370 trillion yen, which translates to about 2.28 trillion US dollars to be invested by 2040.
$2.28 trillion. That is a lot of money to find.
Right. And they are pouring this capital into semiconductors, artificial intelligence infrastructure, energy transition, you name it. You simply cannot finance a $2.28 trillion national overhaul solely through the domestic yen bond market.
The scale just demands international capital.
It really does. And you also have to factor in Japan's structural demographics. They are dealing with an aging, shrinking population and totally stagnant domestic demand.
So if you're a Japanese corporation sitting on cash, You can't rely on selling more products at home to generate growth.
Exactly. You are practically forced to buy overseas assets, which perfectly explains the massive outbound M&A activity we're seeing.
Like Sompo buying Aspen Insurance or Mizuho investing heavily in Indian non-banking financial companies.
Precisely. They are shopping abroad for revenue streams. But, and this is where it gets really interesting, looking at the mechanics of how they are actually funding this, there is a highly technical maneuver happening behind the scenes.
Yeah, right, the swap trick.
Yes. Japanese companies are utilizing the swap market to artificially lower their borrowing costs. Because of current distortions in the global yield curve, a Japanese company can issue a bond in US dollars and then use financial derivatives to swap the payments back into yen.
Sounds super complicated for the average listener.
It is a bit, yeah. But because of the interest rate differential between the US Fed and the Bank of Japan, this maneuver actually creates a synthetic yen borrowing rate that is often cheaper than if they had just issued a domestic bond in Tokyo.
So looking at the data, it's basically like using a specialized travel credit card, right?
No, that's a great analogy.
Like you make a purchase in a foreign currency, but because the underlying exchange rates are temporarily glitching in your favor, you actually get a hidden discount compared to just using your own cash.
That is exactly what corporate treasury departments are doing. They are exploiting those exact inefficiencies.
Well, wait, isn't relying on financial glitches like currency swaps inherently risky? Like what if the glitch fixes itself?
Oh, it is incredibly risky. Those swap advantages change rapidly. They expand and contract based on every single policy move made by the Fed and the BOJ. If the U.S. cuts rates aggressively, or Japan hikes faster than expected,
The map blows up.
boom! The math on that cross-currency swap blows up, and that synthetic discount completely disappears. They could be stuck with much higher servicing costs.
That seems like a massive refinancing risk down the road.
It is, but regardless of the financial alchemy, the broader takeaway is Japan's total transformation. They have transitioned from a deflationary conservative economy that just hoarded savings into an inflationary aggressive entity focused on overseas growth.
Okay, so that brings us back to the old anchor store of our economic shopping mall. If Japan is vacuuming up all this global capital to build out AI and expand, what exactly happened to China? Did they just go broke?
No, China isn't gone. Their role just fundamentally internalized. I mean, top-tier corporate champions still have access to global markets. Like in June 2026, Tencent successfully raised about $4 billion using a mix of US dollar and offshore yuan bonds.
Okay, so they can still raise money if they want to.
Sure, the elite companies can, but the aggregate volume tells the real story. China is heavily focused on domestic funding now. The government is actively absorbing troubled local debt by issuing ultra-long special treasury bonds.
Yeah, I read they are pumping those out at a rate of 1.3 trillion yuan a year.
Exactly. And in July, Beijing increased the southbound Bond Connect quota by 60%, pushing it up to 800 billion yuan.
Which basically signals they intend to build up Hong Kong's financial market to handle their capital needs instead of relying on New York or London.
Right. They're constructing a financial walled garden, you know. They want to control the flow of capital and manage their domestic debt privately.
It kind of reminds me of a massive, publicly traded corporation that just gets tired of dealing with Wall Street analysts and decides to take itself private.
Yes, that is a perfect way to phrase it.
They aren't broke. They just close the doors to the public.
Mhm.
They're handling their money in-house now.
And that internalization carries a severe warning for anyone listening who might be looking to invest in Chinese debt.
Right, because just because the domestic system is stable doesn't mean offshore investors are safe.
Precisely. If you hold an offshore dollar bond issued by a Chinese developer and that company runs into trouble, the legal structure is going to leave you out in the cold.
Because the Chinese government is going to prioritize their own local banks and citizens first.
Exactly. You cannot simply look at China's massive wealth and assume your offshore corporate bond is implicitly guaranteed by the state. The rules of the game are completely different outside their walled garden.
That is a crucial distinction. Okay, so China is internalizing, and Japan is outward bound and borrowing heavily. But I noticed a surprising trend in the recent data about how Japan is borrowing. They aren't just using US dollars anymore.
Ah, yes. The surge of the euro in the Asian corporate money market. It is one of the most defining shifts of 2026.
Which is wild because historically, if an Asian corporation wanted international capital, they issued a dollar bond. It was the default setting.
Right, but euro-denominated bonds made up a full third of the entire Asian offshore market in the second quarter of 2026.
A third.
A third. If you go back to 2021, that number was sitting at just 8%. Japanese issuers alone sold 18.5 billion euros in bonds by late April. That's more than 5 times the amount from the previous year.
Okay, so knowing our current political landscape, with Trump back in the White House and all this talk about U.S. trade tensions, massive fiscal deficits, and tariffs, it is really easy to look at this euro surge and assume this is political. Like, is this de-dollarization? Are they abandoning the U.S. dollar out of protest?
It's a very popular media narrative, I'll give you that. But the reality on the trading desks is entirely different. It is not a political boycott.
Really, it's not about the tariffs or the deficits.
I mean, the US dollar remains the undisputed king for global trade settlement. What we are seeing with this flood of euro issuance is simply pragmatic corporate liability management. It is practical diversification.
Oh, I see. So it's a math equation, not a political statement.
Exactly. When U.S. fiscal deficits run hot and trade tensions inject volatility, it becomes a massive risk for a corporate treasurer to hold 100% of their debt in a single currency.
So it's basically like keeping both a Visa and a MasterCard in your wallet just in case.
Yes, you don't get the second card because you hate the first one. You get it because if one network goes down or charges a massive fee, you need an alternative way to transact. Issuing debt in euros just makes robust business sense.
But carrying that second card has to come with a catch, right?
Mhm.
Alternative currencies can't be as smooth as the dollar.
You're completely right. The catch is the liquidity and the wild hedging costs. If you buy a euro-denominated bond issued by a Japanese tech company, the secondary market for that paper in an Asian time zone might be incredibly shallow.
Meaning it's hard to sell if you need cash fast.
Exactly. And the financial engineering required to hedge the currency risk from euros back to yen can be wildly unpredictable. So diversification gives you safety, but it significantly increases the complexity of managing the debt.
Got it. Okay, so this desperate search for yield, diversification, and growth, it eventually funnels down into the riskiest part of the market, right? The high-yield sector, or what people call junk bonds.
Yes, and the structural changes there tell us exactly where the real risk is building up today. Because right now, Asian investment-grade bond spreads are incredibly tight.
Like around 55 basis points as of mid-2026, according to the data.
Right. And what that means in plain English is that the safe margin for investors is practically zero.
So to make any real money, investors are basically forced to take riskier bets.
Exactly. They are pushed into the junk bond market. But the profile of these junk bonds has completely transformed.
Because the Chinese property developers are out.
Right. The new high-yield issuers are Australian mining companies, Indian finance firms, and Japanese tech companies funding AI.
Which brings up a crazy example I saw. In July, India's Shapoorji Pallonji Group issued a 3-year, $650 million bond, and it was offering a massive 14.50% yield.
A 14.50% yield is essentially distress-level pricing on a brand new issue. It shows that global investors are perfectly willing to take on massive risk if they get a huge payout.
So in the past, a high-yield junk bond in Asia meant betting on a half-built apartment complex in China. But now, it means betting on a shiny new AI data center in Japan or a high-leverage finance firm in India. The risk didn't disappear. It just changed its outfit.
I agree enthusiastically, and this introduces a massive friction point with the AI boom. Stock market investors love the AI growth story, right? They see infinite growth.
Right. They want the tech firm to conquer the world.
But bond investors do not care about the narrative. They just want reliable cash flow to pay the interest. And AI CapEx, capital expenditure, is a major credit risk because building AI infrastructure takes a very long time to pay off.
And technology changes incredibly fast. Like, the chips might be obsolete before the data center's even built.
Exactly. So if institutional money continues to blindly chase yield, throwing capital at anything with the letters AI attached to it, the market is setting itself up for a severe reckoning. The AI boom could easily create the same kind of messy debt bubble that Chinese real estate did.
Wow. That is an incredibly sobering reality check. So, just to quickly recap our journey today, the center of the Asian financial universe has definitively moved from China to Japan. It has moved from real estate to AI, and from a strict dollar monopoly to a multi-currency strategy.
The entire map has been redrawn.
It really has.
Mm.
Which leaves us with one final, very provocative thought for you to chew on. If the massive trillion-dollar infrastructure for the global AI boom is increasingly being funded by high-risk, high-yield debt in Asia, what happens to the global tech industry if just one of these massive AI bets goes bankrupt?
It's the domino effect that everyone needs to be watching out for.
Definitely a dynamic that will dictate the markets in the months to come. Don't forget to subscribe and hit that like button.